Welcome to Virtual Ron, where we unpack the most misunderstood aspects of cybersecurity and venture capital without the jargon and definitely without the suits. Today, we're talking fundraising. And to help keep us grounded and entertained, I've invited a few friends with some wild and real stories. Let's start by demystifying who actually invests in companies. You've got angel investors, early believers, sometimes friends, sometimes rich nerds with time, venture capitalists, professional investors with other people's money, growth equity folks looking for traction and scaling, private equity, they want cash flow and control, strategics, big companies wanting what you have or trying to stop it. But it's never that simple, is it? For our first guest, meet Quozon9, a serial entrepreneur who learned the hard way how different these players can be.
Thanks, Ron. So my first startup, the Pocket Probe, raised $50K from an angel. He was also my dad's dentist. Friendly terms, no drama. My second startup, Viltronic, we got $3 million from a VC, from one of the moons of Uranus, mind you. Great until we missed a quarter and the board meeting became an intervention. By startup 3, Zapped, I built a product, customers, and revenue before even calling a VC. That changed everything.
So, VC's great when they help, scary when they're on your cap table too early and you feel like you are working for them. A SAFE is like a love letter that says, we'll give you cash now and figure out how much ownership we get later when you raise a real round. I jokingly call these mob deals. It's an agreement that reads like a loan, but the interest you get on the loan and the principal of the loan can be used to buy future stock at a discount. Let's hear about a real SAFE experience from our next guest, Marcus.
Thank you. My first raise was $250K from 3 angels. I used safes with a $5 million valuation cap. It meant if I ever raised the Series A, those investors would convert into stock as if they'd invested at $5 million, even if the Series A priced at $10 million. They got rewarded for taking the early risk by getting the right to buy future stock at a discount. No board seats, no interest, no maturity date. Just simple until you have to explain dilution to your co-founders.
Exactly. Safes are like, we'll settle up later. Great for speed, but risky if you don't understand how caps and discounts work. A priced round is a real stock transaction. You agree on a valuation, issue shares, and add investors to your cap table. There's usually a board seat, legal fees, and sometimes complex terms. Ava's here to break down how priced rounds really work and what founders should watch out for before signing on the dotted line.
We raised $1 million at a $4 million pre-money. That gave the investor 20% of the company. We had to clean up our legal docs, add a board seat, and issue stock certificates. But it gave us clarity. We knew exactly what we gave up, and it gave us negotiating power down the road. I've heard these Dr. Jekyll and Mr. Hyde stories, but so far, my new board member has been so good to chat with. It's like he's part of the team.
Well, not all VCs are like that. Priced rounds are slower, more expensive, but when done right, they give structure and legitimacy, and they're essential if you're serious about follow-on funding. A key point about stock deals is that typically the new stock is issued at a higher price than the existing stock. Existing investors get diluted, a term for meaning they own less of a company, but the amount of equity, as in the value of their stock, is worth more. For example, let's say 2 founders each own 50% of a company and they each own 10,000 shares. Founder 1 owns half of the company because there are 20,000 total shares and he owns 10,000 of them. Founder 2 owns the other half of the company because she also owns 10,000 shares. They just started this company and they value the shares at $1 each, making the company worth $20,000 and each of the founders $10,000 each. An investor is interested in purchasing 10% of the company. Right now, there are 20,000 shares, and you might think that an investor could purchase 2,000 shares from the employees to own 10%. Your math would not be wrong, but we want the money to go to the company and not the founders. Founders sometimes sell shares directly to investors, and this is called secondary sales. For the company to receive investment in exchange for stock, the company needs to issue new stock at a price and amount. This is usually a heavily set of negotiated terms. You have the purchase price of the new stock, and you have the total amount of new stock. For our example company, if we have 20,000 shares and the desired ownership is 10%, there is a simple equation we can look at. New shares divided by 20,000 plus new shares equals 10%. In our case, if the company issues 2,222 shares to the new investor, there will be 22,222 shares outstanding, and the investor will own roughly 10% of the company. At $10 a share, the investor would pay $22,222 to the company. If the shares were purchased at $10 each, the company would be worth $10 times the total number of shares, which would be $222,222. Each founder who owned 50% of the company before the investment had 10,000 shares and was worth $1 per share or $10,000, now owns about 45% of the company but is worth $100,000. Even though the founders have been diluted, they are worth more on paper.
That's great, Ron, but you never did an example of a safe note.
I'm glad you brought that up, VC.
A safe note is a lot easier to understand when you have a priced round.
Let's say our two founders also had a safe note and raised a $5,000 investment from an earlier angel investor for a note. That earlier investor does not get any stock until the company is acquired or it raises money at a new valuation. Most of the time, safe notes have terms that dictate a cheaper price for the earlier investor to purchase a stock. Usually this includes interest. For example, let's say the terms were 5% interest on the $5,000 per year, and they get to buy stock with a 20% discount. Assuming it's been 1 year, the earlier investor has $5,250 of value to purchase shares. Since the earlier investor can purchase shares at $8 a share, 20% discount on the $10 price, they can buy $5,250 divided by $8 share for $656.
What happens to the new investor who wanted to buy 10% of the company?
Typically, once the price of the stock has been agreed to, the notes would convert to shares before the amount of new shares would be computed. In this case, instead of figuring out how many new shares can get added to 20,000 shares, we would do that calculation with 20,656 B825 shares. And to make things even more complex, a lot of accounts will split shares, so we have whole numbers of shares. Incidentally, with this safe note example, the founders would still be worth $100K on paper, but would own less of the company than 45% each. Your A round is typically your first priced round. Your B round is your next priced round. If you sold your shares for $10 in your A, hopefully you are selling your B round stock at a much higher price. Atai, as you invest your funds and grow your company, the competitive nature of your company, as well as hopefully increase revenue, will cause new investors to be interested in buying your stock at higher and higher prices. If you don't execute, the market changes or any potential of 1,000s of things that can go wrong in business, you might need to sell another note. Doing a note after a priced round is typically called a bridge round. And finally, if things go poorly, you might have to sell stock at a lower value than your current stock price. This happens more often than you think and is called a down round. There are so many myths about fundraising. Let's bust a few. Ron, myth number 1, you need a pitch deck to raise. Nope. If someone trusts you, they'll wire money without a slide deck. It happens more than you think.
I raised my first $50K over coffee meetings, just screenshots and conversations. One investor said, "I don't need a deck. I need to believe you'll execute." I sent a term sheet via DocuSign that night.
That's right. I like to invest a small amount in lots of startups. I've invested $50K in over 100 companies.
That's great. Hey, I'm looking for your thoughts on hiring my first HR person. Should I outsource or can I?
Seems like that was a spray and pray type of seed investor. Now, of course, I like to see a 5-slide pitch deck, but a lot of what Gula Tech Adventures is investing in are later stage seed and Series A companies. Ron, myth number 2, VCs want to replace you. Not always, but they do want you coachable. It's an unfortunate part of startup life that all CEOs become company-limiting CEOs. Some founders hit this point before they get past $1 in ARR. Other founders can't scale past 20 million in ARR.
I've been on both sides. As a VC now, I look for founders who listen, not obey, just listen. The myth that we want your job is false. We already have stressful jobs. I want our portfolio CEOs to grow into great leaders. I like to say we are available, but not responsible. Ultimately, it's your call what to do. Now drop and give me 200 growth. followed by a profitable quarter.
A lot of time when we run into issues with helping a company grow, it's often that a founder wants our approval and not our advice. Ron, myth number 3, you need a warm intro. Not true anymore, just be clever and persistent. Some founders have DM'd investors on X and gotten pitch meetings. In real life, the real Ron Gula gets a majority of our leads from other founders, other venture capital firms we've worked with or co-invested before, and of course from the videos we put on our YouTube and X.
I cold DM'd 40 investors with a Loom video shared on LinkedIn. 3 responded. 1 invested $500K. I never had an intro. I just respected their time and gave value upfront. I also found the 5-slide pitch deck super helpful. I got to a no very early, which saved time, and it was sure the yes investors were serious. Not knowing this firm, I did a lot of diligence on them, and once I was satisfied they were a good fit for us, I accepted a term sheet.
Myth number 5, VCs are the enemy. They're not, but they do have their own jobs, fun timelines, and bosses. When you take on a VC investor, you might adopt an US against them disposition. The reality is, for seed, you likely still own the company. The VC might have some superpowers like having a right of first refusal on mergers and acquisitions or new investments, but it's still your company. Keep this in mind when a VC is giving you advice. Vanessa's here to remind you that when the ink's dry, the company's still yours.
Founders forget VCs are fiduciaries. Their loyalty is to LPs. When you understand their incentive structure, you stop seeing them as enemies and start treating them as business partners with boundaries.
I don't invest because I want control. I invest because I believe in the mission. Also, I have a BAT exit strategy. Always.
Your cap table is insignificant next to the power of liquidation preferences. But I am not your enemy, unless you cross my term sheet.
Gula Tech has worked with many different other VCs as co-investors. They do have their own investors they need to be beholden to, but the reality is every VC has a distribution of frustration, returns, and joy from working with companies across their portfolio. Most portfolio founders never know where they stand compared to all the other portfolio companies and forget that a VC, even a young one, has seen enough success and failure to give advice that is usually well heeded. Raising money is not a badge, it's a tool. Tools require skill. Whether you're wielding a safe, a note, or a full-blown priced round, just make sure you understand the terms, because the wrong terms can be worse than no money at all. If you want to contact us, feel free to email a 5-slide pitch deck to investor@gula.tech or contact Ron Gula in real life on LinkedIn. Be sure to check out our other videos on this channel that deal with startup advice and cybersecurity tech and interviews with tech and cyber leaders. Thanks for watching, and don't forget to like and subscribe.